Hello and welcome to our latest Insider interview. I'm Kyle Caldwell and today I have with me Brian Kersmanc, Fund Manager of the GQG Partners Global Equity Fund. Brian, thanks for coming in today.
No, thank you very much for having me.
So Brian, one of the key differences between this fund and other global strategies is that you have exposure to emerging markets. India is your second biggest country weighting, so could you talk us through that?
Yeah, so in terms of the emerging markets, we're very opportunistic. We want to go to the different places where we can achieve our sort of objective, our goal of quality compounding over the course of time. So why limit out a market or sort of an area of the market that we think that we can actually achieve that? The emerging markets are actually a really interesting place to us at this point in time. There's a lot of markets there that have been growing pretty rapidly over the course of the past almost decade. Liquidity has gotten a lot better within these markets. In fact, a lot of people are surprised to hear that liquidity in terms of daily trading volume within the EM markets has gone up 4 times over the course of the last 8 years. So there's a lot more liquidity that you can move around and sort of be sort of nimble, if you will, in the EM space. In terms of sizing, I think a lot of people are surprised to hear as well that the top 7 countries from the developed market standpoint outside of the United States are actually now smaller than the top 7 countries in the EM space in terms of market cap and in terms of GDP. So you're getting a lot more growth and you're getting very large, robust markets, and that's a place that we like to operate in. So coming back to India is a really interesting place because the types of names that we're owning there right now actually are a little more the infrastructure, the utility type of space. And what's interesting about that is you're getting 15 to 20% compound annual growth rates out of these businesses with a long degree of visibility of where those earnings are coming from. I mean, these are like SaaS-like growth rates that we're getting out of these types of names, but it's the boring classic utility that we're used to sort of falling asleep reading over, but you're getting really, really interesting growth. And if you compare and contrast that to either other areas of the emerging markets, it's just more attractive to us than maybe trying to buy something, out of the e-commerce space within China, for example, that, the multiples may have come down pretty severely, but, the companies are only growing 5% on an annualized basis. So you're really trying to make a call that they're re-accelerating. We're getting really good growth here, fairly undercovered in terms of the sell side. So not necessarily a well-trodden path on the end. And there are also very large liquid names as well. They're a large mega cap space that have just been sort of forgotten about for a while, but they're exhibiting great growth.
The fund holds around 2/3 in the US, which is similar to the MSCI All Country World Index. So how does your exposure differ to the index?
Yeah, so in terms of the way we think about country exposures in general, we are fundamental bottom-up investors, and we're also agnostic to sort of the benchmark sizing. So realistically, if we didn't find any interesting opportunities within the U.S., we could go to a 0 weight. Now, realistically, there always is something interesting going on within a very large, deep market like that. But we can go pretty severely underweight, and we can go pretty severely overweight and go up to 20 percentage points over what we see in the bench. I think it's much more interesting what is the combination or the makeup of those names within that sort of that construct. Even if you just think about the portfolio in general, the top 10 of our portfolio tends to be 35 to 50-ish plus percent of the portfolio overall, and a lot of those names happen to be U.S. names. So it's not even just a function of how much U.S. we're choosing to own. It's what are these individual names, be that in the tech space, be that in the consumer staples space, that we're choosing to own in large size, and we believe that quality compounding from those higher sort of weighted names in our portfolio is what's really driving the force behind the portfolio and the compounding, and we really want to rally around those names and limit exposures to thesis that we don't have as much confidence in. So we really like that top-heavy nature of the portfolio and those concentrated, convicted calls on those names in the U.S. and non-U.S., but yeah, in terms of those names, that we like those as well.
And how hard is it for an active fund manager like yourself to try and beat the global index, particularly at the moment when there's such a narrow set of companies that are dominating, which are, of course, the US technology giants?
So it's an interesting sort of point and observation in that those Magnificent Seven within the U.S., or call it the Super Seven, right? I can't remember the moniker, is in the European landscape as well. They also have a similar sort of analogous group of large market cap names. The fact of the matter is that's where the earnings are coming through. So what we're, again, trying to do is we're just trying to find the area where the earnings are coming through and not pay too egregious of a price for those earnings and for that quality that we're buying. So if that narrower set of names happens to be the area where the earnings are coming through because maybe they're a little bit more well capitalized, they have better free cash flow than other folks, they have better balance sheets, they have better resources and opportunities, then we're more than happy to express sort of the weightings in that direction, and that's what we're doing. We're taking these concentrated calls in these sort of portfolios. But we'll be opportunistic and go where the earnings are. So if this starts to broaden back out, and there's other winners that are out there, we will reallocate the portfolio to those other areas. We have in the past sort of reduced exposure when we didn't think sort of those top names within the U.S. were performers. 2022 is a great example of that, where a lot of these tech names became overly frothy, over extrapolated. So it was very risky owning those, and we went to effectively a zero weight even within our U.S. and global portfolios in terms of tech. So again, it's about how much we choose and when do we choose not to own these things as much as when we choose to own them. But it comes back down to earnings. Our view, earnings are like gravity, and we're going to follow the earnings to sort of the best path to get those quality compounding returns.
The UK is less than 3% of the fund. Is it a stock market that you're looking at a bit more closely now, given the cheap valuations on offer?
Yeah, so valuations aside, the UK is a fairly attractive deep market overall within the European landscape and within sort of the developed landscape overall. There are names that we deem high quality within the UK landscape. The opportunity set is just dictating that there's more interesting names with better fundamentals from a bottom-up basis with attractive valuations in other places right now. It doesn't mean we can't own things within the UK. I would actually argue over the past couple of years, UK and Europe combined was a very large weighting, actually very large overweight in, we have an international ex-US product. And it wasn't necessarily because we're overly bullish on the macro environment behind the UK or overly bullish on the macro environment behind continental Europe. It was more the individual names that were sitting in there. So if you're an AstraZeneca, for example, and you're selling oncology drugs, and you're a very solid compounder, you have a lot of drugs coming down the pipeline that are potential winners to extend that pipeline, that visibility, and you're trading at a reasonable multiple. That's something that's still interesting to us from a UK perspective. It doesn't matter that's in the UK, if it's in continental Europe or is in the US. That is a interesting fundamental bottom-up risk reward to us. So it's less about where the country is. It's much more about what is the fundamental opportunity set and where we choose to sort of weight those names.
And when was the last time that you bought a new holding for the global fund? Could you name it and explain why you did purchase it?
Yeah, so we're making changes constantly. The idea being, and I love using this analogy in terms of managing in the way we think about managing the portfolio, it's almost like you're putting a sports team on the field and you have an expectation or what you believe is going to happen. You put the players on the field in the beginning of the game that you think are going to execute really well over the next several quarters of the game or what have you. In our case, it's a 5-year outlook. But then as the game starts, things evolve. Certain players do better than you thought. Certain players do worse. You may want to substitute certain players out. The opponents may do something different. The conditions may change. Might be a bright sunny day, kind of like the weather in London. You could have a bright sunny day and 15 minutes later it could be pouring rain on you. You want to adjust to the conditions as the conditions adjust. We look at portfolio turnover in the same way. We want to continually optimize based on what we see here and now. So if I have to take a player or a name out of the portfolio because it's not optimized for the current environment, that doesn't mean that we can never buy that back again. We can re-engage that name, especially in the large liquid, mega cap space that we're operating. We can re-engage that name later and optimize that over the course of time. So we're constantly making tweaks and adjustments to the portfolio over the course of time. Another thing that a lot of portfolio managers don't do too well, this is us included, we're terrible, we all are, as a breed, we're terrible at sell discipline. But having this sort of constant churn and reevaluation of names and putting them against what's already in your portfolio actually helps with your sell discipline to some extent, because the thesis becomes stale. You find this other name that you think is interesting, well, you have to find a place to fund that from. So allowing a certain level of turnover in the portfolio actually helps with that sell discipline, because let's face it, everybody sells based on, the fundamentals have deteriorated, the price got too expensive for the stock. By the time all of these things sort of happen, come to fruition, the stock's already lost value in terms of that. So having this constant reevaluation keeps the portfolio fresh, so to speak, with more up-to-date thesis, and you can let that compound over the course of time and optimize it. To kind of go back to the original question that you asked me, what are some of the additional things that we've done more recently? We have gotten back into a little more of those staples names more recently, more steady Eddie types of names overall. The valuations look a little bit more attractive. So as we had brought down some of that tech exposure within the last couple of months, we have sort of increased some of these types of names that look a little more interesting on a fundamental bottom-up basis. But again, it's not that we ever fully dismissed and never wanted to buy those names again. It's not that we're fully dismissing the tech names that we've reduced the exposure in. It's back to that analogy that I mentioned. You might be putting that player on the bench and having them sit as sort of the next person coming in, and then when the timing is right, the conditions are more favorable, you can re-engage that player and bring that back in. Staples were brought off the bench and brought back into the portfolio, so to speak.
In the past, the fund has been quick to move when you spot an opportunity, or to reduce a sector if you think that sector is losing its shine. So what opportunities are you finding at the moment?
Yeah, so again, it's a fundamental bottom-up process. So we're going through and reassessing all the data points and the probabilities of what the different outcomes that could come over the course of time. In terms of the reaction to that, the way I like to describe it is it's an asymmetric reaction function to risk versus opportunity. Because we're looking at risk in an absolute term, not necessarily a relative term, if we believe that there is an increasing risk to the portfolio, even if we don't have all the information, I always joke that it's almost like a shoot first, ask questions later mentality to risk management. So let's pull back so we can fully understand what that risk is. If that means you're selling down a name, if that means you're selling out a name, let's back off to make sure that we understand that risk a little bit better. And then if that risk ends up not being as bad as we thought, we can re-engage back into that name later. In terms of, on the opposite end, in terms of the opportunity, we need to see the data coming through to say, okay, this is a more compelling opportunity. So if a name is just simply coming off the bottom, the valuations are looking more reasonable, it's hard for us to keep pace in that type of an environment because that's just a sentiment change. Q1 of 2023 is a great example of this. Tech came from, being a zero weight in our portfolio. It was a very unloved part of the market, and towards the end of 2022, December 10th, all those people didn't really like a lot of those tech names, and all of a sudden January 10th, everybody was in love with those names in 2023. That was a valuation-led rebound. It's hard for us to sort of participate in that. But then when we started to see the data points coming through, in terms of the semiconductor demand coming back, in terms of the pricing power coming back, in terms of the AI investment related that was coming back on some of those comm services, the advertising revenue coming back. Once we saw those, we acted very aggressively and repositioned the portfolio. It took us a quarter or two to sort of readjust the portfolio in that direction. So we tend to be a little bit slower in our own terms on sort of that reassessment towards buying into absolute risk and getting into opportunities. I would say we're a little bit faster than maybe sort of the broad set of the ecosystem that might take a little bit longer to do some of those adjustments over the course of time, but very quick to react on the downside or the potential for a downside risk to preserve capital. And
finally, a question we ask all fund managers we interview: do you have skin in the game?
Yeah, so this is something that was a firm belief by our founder, Rajiv Jain. In terms of the founding of the firm, there's two things that we think that are quintessential to any sort of asset manager. Number one, performance is the only thing that matters. This is the only industry in the entire world where you can go and get average for free. So if we're not delivering outsized performance, you can go buy an index fund and you can replicate our average performance if that's what we're putting up for free. So there's no reason for us to exist without performance. The second thing that we really wanted to hold on to is to set a benchmark standard in terms of eating our own cooking, or client alignment, so to speak. And one of the things that we do for that is we actually have a policy at GQG that we're not allowed to do personal trading. So myself, any of the other sales team members, our front desk receptionists, we're not allowed to own anything other than index funds or GQG strategies. So a heavy commitment to capital in that sense. As a PM, I have a substantial portion of my own net worth invested in the strategies alongside of investors, way more than my wife is comfortable with, I can assure you. And I get the question, I promise you, that if we lose 5 to 10% in a year, it's not about how you beat the benchmark, it's about how I just lost 5 to 10% of my kids' college education savings. But also our founder, Rajiv Jain, actually takes it further. He has the overwhelming majority of his net worth invested in the same products, strategies, and vehicles alongside of investors. So something we take near and dear to heart. We only want to do well when our clients do well, and we exhibit that in terms of putting our money where our mouth is, so to speak.
Brian, thanks for coming in today.
Thanks for having me. Appreciate the discussion.
That's it for our latest Insider interview. Hope you've enjoyed it. Let us know what you think. You can comment, like, and do hit that subscribe button. And hopefully, I'll see you again next time.